So you're a first-time home buyer. Here are some words that you may not know that may be helpful when you're buying your first home. Amortization of the loan. This is the gradual loan repayment through regular payments with a portion going to your interest and a portion going to your principal. So when they say the loan is amortized over 30 years, that's basically a portion going to the principal, a portion going to interest, and that amount changes over time. It is front loaded so that you're paying a bunch of interest in the first couple years and you gradually start paying off the principal. So your last couple payments of that 30-year mortgage are going to be going almost all towards principal because you've essentially paid off all the interest that you would have, okay? Next up, we have appraisal contingency. This is a clause that allows buyers to back out if the home's appraised value is less than the purchase price. Plain and simple. Next up, we have earnest money deposit, EMD for short. You'll probably heard it called EMD. You'll never even hear it called earnest money deposit. But this is your deposit. This is your good faith deposit to the title company that you are going to move forward in purchasing the property. One thing to know, once you sign the contract, that earnest money is due to the seller. It's due to the title company. Just because you haven't paid it to the title company yet and you change your mind and you want to back out, that doesn't mean you're not obligated to pay that. It is due upon signature of the contract to the seller. You may have 3 days to give it to the title company, but it is technically due, and you would, if you go to court, you would be ordered to probably pay that if you defaulted on the contract. Next up, title insurance. This will protect you against financial loss due to defects in the property's title. What is really the difference between a pre-approval and a pre-qualification letter from your lender? Your pre-approval is a formal lender review of your finances for your borrowing amount. A pre-qualification is an informal estimate based on self-reported info. Meaning they didn't actually pull credit. They didn't ask for proof of employment and some other things to get you full approval. So that is the difference between those. Next up, points. What are points? These are fees that are paid to the lender at closing for a reduced interest rate. So basically, you could pay X amount of dollars, whatever the lender's charging, in order to buy your interest rate down. It's a one-time fee, you pay it up front, and you can basically get a lower interest rate that you will be paying for the life of that loan, okay? 1 point equals 1% of the loan amount. PITI, you ever heard of that? PITI, principal, interest, taxes, and insurance. Those are the 4 components of your monthly mortgage payment. Next up, we have PMI, private mortgage insurance. This is insurance that protects the lender if the borrower defaults and is usually required if you're putting down less than 20%. So if you're a borrower and you are only putting 10% down on a conventional loan, you will have to pay what they call PMI, mortgage insurance, ensuring that if you default, that lender is taken care of. Now, the cool thing about conventional loans is, let's say you make a couple extra payments or the market does really good and your home appreciates by 15% over a couple years and you decide to go refi, you can actually get that mortgage insurance removed once you get to 20% equity in your home, okay? So that doesn't stay on there forever, but you have to get to 20% typically. FHA financing is a little different. FHA financing typically sticks with the property for the life of the loan. Now, you can, if the only way you qualify right now is FHA financing, but you don't want to pay PMI for your forever, at some point, you could refinance down the road and maybe refinance out of an FHA loan and into a conventional loan if your financial situation allows for that. So that's just something to think about. Next up, closing costs. What are your closing costs? These are the fees and the expenses that will finalize, that are paid at closing to basically finalize the transaction. Typically, these costs are gonna run somewhere between 2 and 5% of the purchase price, and the seller can actually pay some of this on your behalf depending on the loan type, depending on your market. There's a lot of variables there, but it is something that the seller a lot of times can help with paying those costs. And those costs are on top of whatever your down payment is. So let's say you're putting 20% down, you're gonna have to come up with 20% plus the 2 to 5% for the closing costs. Next up, DTI, debt to income ratio. This is the percentage of monthly income that you're receiving that's going towards debt payments. This is used by lenders to assess affordability. So basically, if you're making X amount of money a month, but you have 3 motorcycles, a boat payment, 3 car payments, child support, and all of these other monthly obligations, that is going to hurt you in the qualifying process to where you may not qualify for what you think you would because you have too many monthly payments going out. Next up, this one I'm sure you've heard of, but then again, you're a first-time home buyer, so maybe not. HOA, Home Owners Association. This is an organization that manages the rules and the maintenance of a community, and it is funded by you, the homeowner. So it is a monthly or quarterly fee that is collected by typically a rental management or a management company that is managing the HOA, okay? And they basically use that and keep the money there to pay for anything that needs to be done as far as maintenance and general upkeep of the community. FHA loans. These are mortgage insured loans by the FHA, allowing lower down payments and flexible credit requirements. So if you can't qualify for a conventional loan, you may have to go the FHA route. Another thing you need to know is contingencies. What are contingencies? Contingencies are something that maybe you have to work into an offer in order to get your offer submitted. You may have contingent upon a home inspection or contingent upon financing, right? And if you weren't a first-time home buyer, you may have to sell another house. You could have contingent on selling your current home as a contingency. And these are things that you have to meet these contingencies in order to move forward with the buying process. If the contingencies aren't met, you technically can't move forward in most cases. So these are some of the terms that you need to know as a first-time home buyer. Hope you found this helpful. If you're thinking about buying a home and you don't have an agent lined up yet, hit us up. We've helped more buyers purchase homes here along the beautiful Florida Emerald Coast than any other team over the last 5 years. We'd love to help you.